Welcome, sprinters. Today I'm sharing my portfolio, the performance of the last 12 months, mistakes, learnings, my top 5 moving forward, and the new strategy into the year 2025. What is your passive income doing? What is your portfolio doing? Let's review and learn. Overall performance 2024 was 30.31%. So 30% is 6% above the S&P 500, and that's a good performance. But I don't care much about comparing it to the market. I know that many of you want to beat the market. That's why you compare it to the S&P 500. That's why I'm sharing it here. I only care about the overall portfolio number because I don't manage the money of other people. I manage only my money. So I only care about what's the net asset value. Right now it's 1.1 million. We are on track. We are slightly above the performance that we wanted to have. And so that's great. And the year was very turbulent. We made a ton of mistakes. Still, we're up 31%. That's great. Let's see what the current portfolio looks like. We own 11 companies: San Lorenzo, Bookings, HG Capital Trust, Harvia, Amazon, Hermes, Google, Lumine, MasterCard, Visa, and Sophia Genetics. The plan is to own 12 companies, so I have one slot open and I have already an idea which company that will be. But let's start with the mistakes. The biggest mistake 2024 was to accept a high structural risk without downside protection. Now, Simon, come on, how can you say it's a mistake? You made 30%, so you increased your net worth by 1/3 in a year. That's a win. Yes, if you take performance as a criteria for the quality of a decision, then it's a win. But that's not my criteria. My criteria is not performance, it's risk-adjusted performance. So you can take the right decision and still have a bad performance. You can take a bad decision and have a great performance. I think I had bad decisions with a great performance. And that's why the learning is next year, I'm okay with having less performance, but the standard will be higher in terms of risk. The risk will go from high risk to low risk, and I have a plan, and I want to share the plan with you guys because we need a downside protection. What got us here from 50K to 1 million is not what will get us to 6 million. And I will share the plan with you how we get to 6 million. It's gonna be not that hard. But what can happen in between is volatility. And so we have to take care of volatility. I don't think the next 10 years will be as easy going as the last 10 years. That's why I want a better plan. So far, we made 20% over the last 12 years. For the next 12 years, I want to aim at less. I want to aim at 15% annual compound growth, but having downside protection, okay? No way we screw up the downside. How will we do that? I have simplified our system, which makes the screening criteria now much harder. So we will only own 12 high-quality businesses. That means the commodity is out. Remember, our commodity was Bitcoin. That's out. I'm scaling out of Bitcoin at 2% every week. I started as soon as it hit our levels, and we're scaling out. It's the 6th, 7th week that we're scaling out. The 3 principles of the new system are low risk, high pricing power, and letting the winners ride. So Nothing else can enter our portfolio if it doesn't hit one of these. That's the reason why we went out of Tesla. Tesla does not meet the criteria low risk. It's high drama, high risk. So we're out. Same with Bitcoin, same with Solana. We're completely out of Solana. High pricing power. This is where I put all of my effort, and I'm studying everything around pricing power, from Warren Buffett letters to Porter's 5 Forces, everything that can teach us pricing power. I'm on it. And we are even continuing developing those tools and models forward from here. The next book will be around pricing power. That's how much we're learning. And the third thing is to sell less. We will sell less, but Simon, you say this every year and then you don't do it. That's true. Because I had no clue how to do it, but I found a way. And I'm sharing that in a second with you guys. So let's look at the current 11 companies that we own. 12 is what we're allowed to own, right? So these are the 11 companies. Let me make a screenshot here to share with you guys in the community. These are the 11 companies. And if you're listening, it's San Lorenzo, Bookings, HG Capital, Harvia, Amazon, Hermes, Google, Lumine, MasterCard, Visa, and Sophia Genetics. That's the companies that we have right now. They have strong pricing power. They have a very disciplined cost control and financial management. Many of them do buybacks, which I particularly like, and they have room to grow. We bought most of San Lorenzo during November 2024, when the valuation was super low, but the fundamentals were super high. That's the game of investing, right? So if the fundamentals are great, but the valuation, that means the price is low, that's when you should buy. And so we went heavy into San Lorenzo in November. Then in December, the CEO, Massimo Perotti, started buying, and he rarely buys. So we bought even more San Lorenzo. Now we are overweight San Lorenzo, and I'm fine with that. Fundamentals are so strong. And here are the 10 reasons why we bought San Lorenzo. The moat is widening, specifically in the 40 meters to 50 meters yachts. The pricing power is intact. My confidence is very high. Also, the team's confidence. Cost control, fantastic. Optionality, yes, they can go. They both swan for smaller products. They can go bigger products and compete with the Italian C Group. So a lot of optionality, very profitable, very predictable, top capital allocators. They're using float, so they have low risk because they start building it after they get the money. The incentives are great. Specifically around incentives, I'm looking at how much insider ownership there is. And I just told you that the CEO, who owns a lot of shares, bought even more, and he doesn't have to. So incentives, top. And yes, it's undervalued. I shared the exact valuation, both the DCF and the exit valuation in our community. So yeah, we bought, and I hope you bought with us. Plan for 2025 is to scale out of our only commodity, which is BTC, and reinvest all of that into 12 companies. Now, Simon, you said that you own 11 companies. What's the 12th? Let's have a look. I run the S&P 500 through this screener, which is what are the highest quality companies. I run them through basically screened by more than 15% earnings per share growth and more than 20% return on capital employed. Because if you can pass this test, now you're a compounding machine. The probability of you creating value under any market condition is very high. You're basically unstoppable, right? And then we have some capital preservation, some defensive plays. But really, the first quadrant is what we were buying. And I've identified one more that I don't own yet, but I will soon. Now, if you want to know which one it is, join our community, strategysprints.com/community. I will tell in real time subscribers when I buy and how much I buy and why I buy. Now, the plan from here forward is to be 70% in spot position. That means holding the stock, but 30% will be having dry powder. Dry powder is cash-like positions that can immediately, they're liquid and they can immediately be used to buy recession dips. Oh, are we expecting a recession? Yes. When will the recession come? Nobody knows. People are waiting for a recession since years, so we don't know. Will it be 25, 26, 27, 28, 29? Nobody knows. But one thing is clear, the market, like everything, is cyclical. So at some point, this thing here will happen. And it's somewhere between 26 and 28, but nobody knows. But I want to be ready. I want to be ready for a recession. And how do you make yourself ready for a recession? Having a big pile of cash. But not cash in terms of fiat currency on your bank account. It will be in a short-term German bond, and it will be in conservative options that are cash equivalents. The goal next year is to go down with our performance from 20% per year to 15% per year. But Simon, you're performing less. Correct. But we will decrease the risk by much more than 5%. And that's the point. We will decrease risk by 30%. And decrease the minimum CAGR, because we can always be surprised by the upside, but the minimum CAGR will be decreased by 5%. This is how you create a risk-adjusted return. Risk-adjusted return. Why? You want to protect the downside and still lose a little bit of the upside, but you want to protect 100% of the downside. This is how Warren Buffett and other super investors have survived all the recessions, by buying first high quality company, and second, by managing their risk so that the number one mistake cannot happen, being wiped out. Everybody who uses leverage can be wiped out, so we will not use leverage. Still, 13th year of no leverage. And mistake number two, not having anything that protects the downside. So the plan from here is, we went from 2012 to 2024 with a 20% CAGR, so we doubled every 3.8 years. It worked. We are above plan here. So we have some leeway, okay? We can relax a little bit, and from now on, 2025 to 45, we will go to a 15% CAGR. Easy, according to the last 12 years, but not so easy because things are cyclical. So we will reduce the risk and keep navigating the waters with the aim of growing 15% plus reducing the downside. We are in 2025 right now. It's the second day for me of 2025, and we are on track. So the milestone is 1 million. We are at 1.1 million. So we are on track. It's fine. What else? What's on my watch list? I will share my watch list today with community members. So go to strategysprints.com/community, because I'm also sharing the new buy in real time when that happens. I hope your portfolio is doing fine, everyone. Let me know what questions you have and what's your plan to reach your million in assets, and keep rolling.